Wouldn't surprise us if we get a little bounce in the market now.
Why now? Why?
Well, because today's low in the S&P came right back down to a trend line that has 4 points on it, so that's a rather important trend line. Post-Fed announcement, we got down to about 1082 or so in the S&P. That's the value of it was 1084, so we dipped, right, and then shot up and had a very strong close. So you've probably seen enough selling for now. Qualcomm, as you mentioned, has a lousy number. It's probably down 7-8% last I looked just before I came to the studios here, so you might see a little pressure. But in general, if the market can kind of hold this trend line, then we'll get a bounce, and we suspect probably 1115 to 1120 in the S&P holds the rally. And then we start moving down again. Worst case scenario for a bear is we rally to 1124 to 1132. That's the best case, we think, on the upside. And you'd have to close above 1132 for us to even partially look at changing our call and think that we're going to
So 11, let's say 1120, 1130, right in there. Yep. That's the top. That's the ceiling right now. We get a bounce
up to, and then we sell off again for another round of selling.
And how far down do we go?
Probably we're talking 1020, that neighborhood, something like that, to do an 11% pullback from the 1150 high.
And what kind of time frame are we speaking about?
I suspect we can do that first quarter.
First quarter?
Yeah.
Get it out of the way, and then what happens? Do you go revisit and you think maybe going long?
Well, we've got to see how much it sells off if it actually stops there. That's our minimal downside target to this move before all is said and done. So we think you'll probably see 1020 before you make new highs. When we get down there, we'll evaluate again and see whether or not it's really time to step in or think if maybe there's more to come.
All right. Now, let me tell you, you do these pair trades. I love it. You know, you come in with these ideas where you kind of blend two ideas into one trade. Now, one you're going to talk about is what? Discover Financial, DFS, as well as Capital One, COF. And you're saying what? Go long, Discover, and short Capital One against it. Why?
Well, we've got our fundamental analyst yesterday put out a piece that talked about why he likes DFS more than Capital One. Capital One caught an upgrade today, so the spread came in a little bit, but it's basically where we suggested a few days ago. Here's your chart. You've got this kind of one-year picture of a downtrend, but we can't quite see it here because all the bottoms are equal. But if you actually looked, you could see that recently over the last few months, the bottoms come in somewhere around 0.33%, meaning that DFS is trading at about a third of the price of Capital One. We think over time we're going to break this downtrend line, move up through it, and hit kind of the neighborhood of, let's say, 0.45.
So the spread narrows?
No, the spread widens out from, let's say, 0.33.
Okay.
All right, because you're long DFS.
You're long DFS and you're short COF.
Right. So we think the spread will probably push out towards the mid to upper 0.4s. In percentage terms, your return on capital would be huge. That's something like a 30% return if you're correct. And the great thing about pair trades is you take the market risk away. This can happen regardless of which way.
Doesn't matter which way the market's going.
Right.
Yeah.
But, of course, you need to be on the right side of the pair trade.
That's why we always have you, and that's why we'll call you if anything goes wrong. All right. I want to thank you very much, Rick Bensignor, coming in from Execution LLC, giving your insight into the stock market as well as another pair trade. Thank you.